All right, let's get the show on the road. Good evening, everyone, and welcome to the Get Ready for End of Financial Year webinar presented to you by Avant Finance, Avant Law, and William Buck. I'd like to start with an acknowledgement to country. And in the spirit of reconciliation, Avant acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. As a national organisation, we pay our respects to elders, past, present, and future, of the lands on which we gather and work, and extend that respect to all Aboriginal and Torres Strait Islander peoples. My name is Junior Osasa, Head of Commercial Lending for New South Wales, Queensland at Avant Finance, and I'll be your host tonight. I'm joined tonight by a powerhouse panel including Paul Copeland from William Buck, Joshua Leslie from Avant Law, and Daniel Pike from our Avant Finance team, who will guide you through this critical period leading up to end of financial year and discuss key topics including year-end tax planning tips and ATO focus for 2026, investments and implementing tax effective structuring, reviewing your practice arrangements to ensure compliance so that you're achieving operational efficiencies in the new financial year, and funding your end of financial year plans and FY26 goals. Just a disclaimer, all the information presented tonight is not comprehensive and doesn't constitute legal, financial, or medical advice. You should, however, seek your own legal or other professional advice before relying on any content presented tonight. Feel free to utilize the Q&A box at the bottom of your screen for any questions you may have. We will have a Q&A section at the end of the presentation where we will do our best to get through as many questions as we can. However, if we don't, we will be in touch directly to set up a free consultation to discuss. So without further ado, I'd like to introduce to you our first panelist, Paul Copeland from William Buck. Paul is a partner at William Buck based in their Brisbane office and has extensive knowledge in the medical and dental industries, covering all areas of general and specialist practices, assisting them with their accounting, tax, and business advisory requirements. Paul is often sought after for advice by members of the AMA Queensland and different property seminars and networks across the state on different issues. Over to you, Paul.
Thanks, Junior. Good evening, everybody. As Junior said, I'm a partner at William Buck. We're a national chartered accounting firm specialising in the health space, and I head up our health division nationally. So if I get the next slide, please. We've got a disclaimer there. We've made it so small that you can't see it. But essentially, as Junior said, it is a professional presentation tonight, but we're giving the information in general in nature. And so therefore, there is an opportunity for you to have a consultation with us at the end where we can talk about your own specific needs. Next one, please. So what I thought I'd start off with is a little bit of tax planning fundamentals. I'll let you in on a little secret from accountants that specialize in the industry, that deal with lots of doctors. We know that you don't like paying tax. But what we want to do is give you some ideas about how to go through and minimize the tax that you're paying. The first one is claim as much as you can. The fundamentals of that are keeping records and keeping the information. If you put in a great effort and keep lots of records, keep lots of receipts and claim and document pretty much everything you think you can claim and then pass it on to your accountant, the accountant will be able to go through and sort through that and say, look, no, nice try, you're not going to get that one. But yes, you actually can claim that one. If you don't let us know that you've gone and spent money on something and you don't let us know what's there, we can't read your mind. And so we can't go through and claim that. The other strategy we use is if we can't minimize the tax, we actually try and defer out payment. So this could be deferring income, it could be deferring capital gains. As we come towards the end of the financial year, a big one to keep in your mind if you're thinking about selling some assets and you might be actually getting a capital gain coming through. For capital gains tax purposes, the tax date is the date of any contract or agreement you enter into. So if you enter into an agreement on the 1st of June and don't settle until July, that will actually be included in the current financial year because it's the date of the contract, not the date of the settlement. And one of the big things we also talk to our clients about is, yes, it's great to get as many tax deductions as you can, but don't go chasing those crazy tax deductions and don't make investment decisions or be doing undertaking activities which is purely tax driven. There's no one out there in Australia that's gone through and done everything they can to minimize tax deductions, but not also had a wealth creation strategy as well as an asset protection strategy. The idea from all of your work as a doctor and earning this income is to build up wealth, invest it wisely, invest it in a safe place so people can't get at it, but then go through and protect that. And at the same time, minimize tax to the extent you can do it legally. What else tonight I'm going to talk about is a big area where the ATO focus is coming through. You may have read, and there is definitely a lot of activity there. The ATO are increasing what we call their data matching. So using computer information to go through and sort out and identify people that might be falling outside of the areas, and looking at them and looking at them more closely. And also, I just wanted to start off as well, if you are unfortunate enough to be picked for an ATO audit, just a couple of quick words there on their tactics. So the first one is what we call phishing audits. So a phishing audit is where the ATO will go through and look at a large group of people for something that would be seeming initially to be quite small. The problem there is when they're going through and looking at this particular area, if they don't find a particular issue there, they may ask you for some more information about some common ATO areas of focus. And that's where they're going through and then trying to widen their search and look at other areas to try and catch you out on. The other one is what we refer to as the ATO shakedown. So the ATO shakedown is coming through, and people think it's a bit of a joke, but it is definitely a tactic they use. They'll come through and sit there and say, look, we know you've done this wrong. If you go through and lodge an amendment and fess up and pay the tax that you haven't paid and you've done the wrong thing here, we will minimize the penalties down. So penalties with the ATO can range up to and over 100% of any tax payable. So this could seem like a great way to minimize your risk. But they're also going through and doing what I like to call their lazy approach, in that they're scaring you into admitting to something that may not have actually happened. And you'll go through and lodge and you'll pay some more tax. They'll fine you 20% of that. But in the some cases, they might not have even caught it anyway. So I call that the ATO shakedown. Next slide, please. I also wanted to make people aware for the 2025 year, these are your thresholds. So when looking at income generation, a lot of doctors will be over the $190,000 threshold. So there's not a lot that you can do there. You can claim the deductions that you can legally. But if you are trading through, if you have investments where you've invested through a trust, if you have passive investments where you're earning income through, there is the opportunity to look and distribute income out maybe to a company, to potentially a spouse who may be on a lower income rate. And when you look at those rates there, if you're looking up to about the $135,000 mark, the tax rate there is about that 25%, and even up to $190,000. The tax rate is averaging or is about 29,000.1, and then it really ticks up after that. So the part of the strategies we do use as accountants is to look at where people's income is and distribute around to try and make the most of those thresholds. Next slide, please. So this one is actually a good slide for everybody. So whether or not you're working for one of the public health systems or you're an individual doctor in practice, this is a common usual suspects tax deductions. And right up the top there is everybody's favorite, which is accounting fees. 99% of the time, your tax agent accounting fees are going to be tax deductible. Courses, conferences, and seminars and travel to them are all tax deductible. A big thing to remember is the actual travel to the conference is a tax deduction. The way you travel doesn't matter. So, for example, you could fly to a conference in Los Angeles, and provided you fly over to Los Angeles and you fly back and there's no holiday or anything involved, that is a tax deduction. If you fly economy or you fly first class, those flights will still be a tax deduction. So the tax office can't tell you how to get there and how to spend your money. They look at the purpose of the trip. Sustenance, again, people when they're going on conferences and courses, you can claim sustenance, which is food and meals a lot in that situation there. But a big point to remember there is you don't want it tipping into entertainment. So if you're going out and you're getting dinner after a seminar and you've got a seminar the next day, that can be a tax deduction. However, if you order $1,000 bottle of wine, The problem there is it could turn into entertainment and therefore not be a deduction. The next one, subscriptions, AMA, college fees, computer software. When used for work, these are tax deductions. Equipment, including mobile phones, when used for work, are a tax deduction. Now, if you're a salary and wage employee or you're in private practice, the way you can claim equipment is different. For those of you that are in private practice and operating under an ABN, you can still claim up until the 30th of June this year, $20,000 for equipment as an instant asset write-off, where that asset is being used in your business. The problem, though, is that after July, this will change, depending on which government comes in our next election. The asset needs to be installed and ready for use by the 30th of June. Also look for work from home allowances, keeping records about how often you might be working from home. Insurances are a big one. Professional indemnity insurance, income protection is a tax deduction, but not your life insurance. Your motor vehicle. Everybody wants to claim their car, which is fine. Your car can be a great tax deduction, but keep a logbook. Make it easy for your tax agent. If you haven't kept the logbook, we cannot legally use that as the way to claim your car. Going through and saying, Paul, I reckon I used my car for 60%. You might say, then that's pretty good. The rules for tax agents have actually changed this year, and it's getting very difficult for us as tax agents where there isn't substantiation for us to make these claims. The tax office is actually cracking down on tax agents themselves where we're not actually doing 100% the right thing. And in this situation, if a client goes through and I say, you haven't got a logbook, so you can't claim it, we legally now have to tell you to go somewhere else. And when you go somewhere else, we have to tell the people that there was an ethical issue with you when you left. So, and if somebody else does the wrong thing, we are legally obligated to dob them into the tax office. So it's gotten very difficult for accountants to be as creative as what we used to be. Other ones on there, superannuation, there was quite a few questions before tonight's seminar about superannuation. The threshold's actually increased this year up to $30,000. But remember, as you're approaching retirement, you should or could be looking at maximizing after-tax contributions into super, using a financial advisor to create this strategy to build wealth in an asset-protected and low-tax environment, which can be your superannuation. A great way to look at that. And again, if your balances are under $500,000, you do have the ability to go back and do some top-up payments and recoup if you haven't been maximizing the superannuation contributions for a while. Another one there, wages and contractors. So we see a lot of instances, particularly with doctors in private practice, where they want to pay a salary to their spouse. Where your spouse is assisting you in income generation and working with you in your practice, this is totally fine. But the key to it is that you can only pay your spouse a commercial rate. You can't go through and pay your spouse $200,000 for doing work that you might pay anybody else that isn't your spouse $5,000 for. The tax office, if they look at that, will consider it tax avoidance, and there are significant penalties for this. Be aware, like I said right at the start, there is a lot more activity with data matching, and you can expect a lot more focus from the tax office on this. Next one, please. One of these ones, we don't see it so much anymore, but it has come across my desk a couple of times in the last probably 6-7 months, is what we call a split loan arrangement. This is where you may, and some accountants will still go out there and encourage it, where you have your home loan, for example, which is up high, and you borrow a new amount of money and you pay all your business expenses through that, and you don't pay it off, and the interest gets capitalized and that loan keeps going up, and you pay down using your income down your home loan. The logic there is to say, technically, I'm paying off my home loan with income coming in, and I'm borrowing to pay business expenses, so that interest should be a tax deduction. On the face of it, it sounds okay. But what you've really got to do is put on your common sense hat and say, would that really pass the pub test? If I went down and I was talking to my colleagues in the office and they said, this is how I've structured my loans, are they going to look at you funny and think, well, I've never heard of that before. It sounds a bit weird. The tax office has gone along and did exactly that, and they've got some high court cases as well as some tax rulings which are targeting this as tax avoidance. So be aware, if you're trying to get a little bit too tricky with home loans and borrowing to pay expenses, the tax office are onto you, and it is one of their areas of focus. Next slide, please. The next one is what we call Division 7A. So this would be where you might be trading under a medical company, which In a lot of cases, it has no benefit anymore, so you should really ask your advisor why. Or you have investments in a company, you've got a company trading where you might be owning a service entity through it, and that company's loaned you money. Now, Division 7A is about looking at those loans. So if a company is trading and it's got investments in it and it loans you money out, it's a tricky way for somebody to get money out of a company where there's investments and not pay tax, because you don't pay tax on a loan. The tax office have gone through, and one of the real big areas is Division 7A. And so a Division 7A loan is where the company's made a loan to you, and you haven't been put in place a documented loan agreement. Be aware that this is a focus for the 2025 financial year. There are significant penalties if you have one of these loans in place and it's undocumented. The other big thing to remember is that this is an asset protection issue. I had a specialist come to me 3 months ago now, and he'd been going to a firm on the Gold Coast, and he's come to me and he said, look, these are my books. Second opinion. We give second opinions all the time. And he said, Paul, I just need a second opinion. Tell me if you think this is okay. And I had a good look at it and I'm saying, yep, this is okay. And then I found he's got this company where he's invested a lot of money into it. And then at the same time, he's also pulled out $400,000 from this company as an undocumented Division 7A loan. The two issues there, it's a Division 7A loan, so meaning the tax office, if they catch it, can go through and assess this doctor for $400,000. He's going to lose half of that in tax. But also from an asset protection point of view, this doctor was going along thinking everything's good, but if he had a claim against him, he's taken $400,000 out of this company. That's an asset of his, and he can go through, and somebody that can take control of that doctor by making a claim and maybe being appointed as a liquidator or receiver can get at that money, and the assets he thought were protected in a structure weren't. And so that again is something to be mindful of. He was really focused on tax, 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 but at the same time had forgotten about asset protection. And so we've got to find that balance, and we always encourage our clients to think about that as well. Next slide, please. Right, so then we had a few questions coming through at the start about personal services income. Can you just click through this one, please? So personal services income is about income that is generated from your personal work. So as a accountant, I generate income coming from my personal work. The tax office have gone through and created a new ruling, tax ruling 2022/3, came out a few years ago. It's all about personal services income. It's highlighting to us their new focus or a renewed focus on the splitting of income by doctors or professionals of their income amongst family members. You cannot legally, no matter what your accountant has told you, operate as a doctor and split that income amongst your family members. This ruling makes it exceptionally clear that this is not on. Next slide, please. It doesn't matter if you pass a personal services business test or whatever, you still need to make sure you are receiving a commercial remuneration in these circumstances, and it falls under the anti-avoidance provisions of the ATO. Next one, please. So these anti-avoidance provisions are all about going through and saying, if I'm a GP, for example, and I set up a company, I can't leave my money in the company and be taxed at 25%. If I'm a GP and I'm trading as a trust, I can't split that income amongst my family members. That's not on. And the same thing if I'm a medical specialist, I can't do the same thing. From a common sense point of view, if you put on your common sense hat and think about it, would it be really feasible to think it's that simple that you can set up a company or trust and suddenly you can split all your income widely? The tax office have thought about it. They've put in this whole raft of legislation around it, and they've made it quite aggressive that if you do it, they will apply anti-avoidance provisions to you. I accept that there are accountants out there that still do it. There aren't a lot of them, but there's still ones out there that don't understand these rules. And the way that I talk to my doctors about it is the old my mate. And I have doctors come to me and saying, I'll say to them, look, you can't trade through a trust. You can't split your income amongst your family. And they'll say to me, but Paul, my mate's been doing this for years and does it and has never had a problem. So my retort to that has now become, my mate smokes 4 packets of cigarettes a day. He hasn't caught lung cancer yet. Should I go out there and smoke 4 packets of cigarettes a day? And if you think about it, you might have your answer. Next slide, please. And here again is a classic one. I've just gone through it. It's a little case one. This is actually coming from the ATO ruling. So when you think about, are we really at risk? Are we on the ATO's radar? The ATO love taking on doctors because generally speaking, their records may not be the best and the income that's being generated is quite high. So in this situation here, you've got Dr. Banks who's billing $400,000 a year, pays his medical center $140,000, and therefore is making about 260 odd thousand dollars coming through his trust. From an ATO PSI point of view, that money needs to go to him. But Dr. Banks has gone through and said, well, I don't like paying tax. So he's gone through and said, I'm going to split 150 to me as a salary. I'm going to give some to the kids and the rest to my wife. And that's what I've done through my trust. And you'd be surprised that every now and again we still see accountants doing this. Very clearly, the ruling states that the ATO will apply the anti-avoidance provisions to this if they catch you and when they catch you, and the position will be that you are in the wrong, it's not a grey area, and you will be in a lot of trouble. Next slide, please. So we don't want you getting caught for this. Rental properties. Rental properties can be a great way to get tax deductions. Negative gearing. You can see there's been some announcements today that if there's a minority government, the Greens in particular, I'm not making any political comment, but saying the Greens in particular are not a big fan of negative gearing. Negative gearing is where you are owning a rental property and the expenses exceed the income coming from that, and you can claim a tax deduction for that. Now, be aware that there are definitely people out there marketing to you as doctors. I've been to some of their seminars where they are flogging you properties that are just rubbish and they want you to buy that. And if the strategy that they're talking to you is not about this property will go up in value and this will create you wealth, but it's a purely tax-driven strategy, please close your ears and walk away. It sounds too good to be true. It's dodgy. Yes, you can claim deductions, but there's a lot of people out there that overinflate the prices of property. I actually went to a seminar once, and I love giving this warning. I went to a seminar once where a person was up there and they were a buyer's advocate telling people about how they were doing this. They were charging everyone that was in the room $25,000 to find this ideal property, but they weren't disclosing, unless it was in very small print on one of the large documents they were giving you, that they were also receiving $25,000 from the developers that they were flogging these properties from as well. And the person said to me in a private meeting, every doctor that comes through the door, Paul, is worth 50 grand to me. And I've been out there since that meeting trying to let people know, don't go through and look at property as a pure tax deduction. It's a wealth-driven strategy. Now, a lot of doctors will also have rental properties and they'll be looking to make claims on them. Be aware the tax office is getting a bit more tricky with their data matching. One of the examples of that is they've now gone through and looking at matching with the banks and looking at the interest that are being charged on particular loans. And the other ones, and that's data matching straight in where they can see who's got what. The other one is that when you lodge a rental property schedule in a tax return, the address of that property is put in. And what we've found lately is they're going through different addresses, say unit blocks, and they're looking at all the rental that's generated and matching it all together. And we've actually had one of our clients get picked up who was doing the right thing, which was good, but they got picked up because the income on that property was significantly lower than everybody else in the property complex, and they got picked for an audit. And this comes back to what I was saying at the start about these phishing audits. They get you on one little thing, and then they start looking at everything else until they find something bigger. Next slide, please. So that brings me to the end of my conversation tonight. Everyone who would like to have a conversation with me afterwards, please click on that. We have extensive experience. I do have health specialist partners throughout Australia, so we're happy to talk to you wherever you are in Australia. And even if anyone's from New Zealand, we have offices in New Zealand as well. We are here to assist. We will push and claim as much as we possibly can, but our job is to make sure that you can sleep at night and you also use your money to invest and grow and build your wealth. Hand back now to Junior, I think.
Thank you, Paul. Some key messages there around tax planning, in particular, what you can and can't claim and where the ATO's focus is. Thank you very much. Our next panelist is Joshua Leslie from Avant Law, who's going to speak about reviewing your practice arrangements to ensure compliance to enhance your operational efficiencies. Over to you, Joshua.
Thanks, Junior, and thanks, Paul. That was hard to follow from from interest. So my name's Joshua. I'm one of the senior lawyers in Avant Law. I work in both the commercial team and the property team. Go to the next slide. So for end financial year, it's a good opportunity to look, I think, both forward and backwards. So what I've done is kind of done a recap of some of the regulatory trends and changes that occurred this financial year. I'll look at also some of the forward changes that are going to occur next year and beyond, and then also look at some of the existing practice arrangements and kind of undertaking a health check of how we can kind of maximize best practice for our contracts and our practice arrangements. So I'm just going to briefly discuss these changes that have occurred this financial year as a kind of catch up or summary of the changes in case you've missed any of them. I'll kind of be simplifying the concept. So if you have specific questions about any of the regulatory changes, feel free to ask them in the Q&A or reach out to me afterwards or anyone in the Avant Law team. So the significant changes to the privacy laws and regulations that have just occurred very recently and just passed Parliament. There's a new statutory tort of serious invasion of privacy, which expands the risks for a claim where someone's privacy has been substantially breached. It's a criminal offence and there's quite significant penalties for that. The OAIC has got increased enforcement powers, and they've also simplified some of their cross-jurisdictional requirements for passing private information overseas. So what they'll do is they'll whitelist certain countries, in which case if you've got overseas call centres or you've got some sort of financial or business management, they can help you with that. And you don't have to jump through the hurdles you previously had to jump through. There's been considerable employment reforms that occur this year. Probably the biggest one is the wage theft laws, where there's a criminal assessment of wage theft. So it ties to a deliberate and continuous act of wage theft. There's an opportunity for imprisonment. There's fines of up to $1.5 million for individuals or $7.8 million for companies. All of the civil penalties for wage theft, even inadvertent wage theft, have been increased. In Queensland, some changes around work-related sexual harassment, positive duties in Queensland to prevent sexual harassment and sexual-based harassment at work. Also a requirement to have a prevention plan as of 1 March 2025 about how businesses in Queensland are dealing with that positive duty. New South Wales have expanded their industrial manslaughter laws, so there's now criminal penalties for breaches of those, the work health and safety regulations. There's a right to disconnect law that came in recently. I think everyone should be pretty comfortable around those requirements, but the requirements for employees to not have to or disconnect from devices or external devices when asked to do actions outside of work hours. Real trends in the psychosocial risks in the last 12 to 24 months. These are kind of risks that relate to stress and burnout. The take used to be always that it was a reactive approach and that someone would suffer one of these events and make a worth health claim. But the shift these days is really moving towards a proactive approach. We've seen a lot of regulators, inspectors entering workplaces to assess compliance from the psychosocial angles. New reforms in cybersecurity. So there's mandatory reporting of ransomware attacks now. So if you are a reporting body, which is a business in Australia that earns more than $3 million in revenue, you've got a mandatory obligation where you've suffered a cybersecurity event and there's a ransom involved as part of that process. There's penalties for any businesses who don't comply with those cybersecurity mandatory reporting obligations. There's also some Aged Care Act reforms. It's probably not as relevant for many on this webinar, but will apply to some. It's a big step towards kind of fulfilling those recommendations that came out of the Royal Commission for Aged Care. Next slide. So in 2025, we'll see some real additional reforms to the privacy laws. So what we'll see is a right to delete. That is a positive right for anyone who holds privacy data to require their information to be deleted from how it's being stored. And obviously, the example is, you think about Optus and their data breach years ago, and you wonder why, when I haven't used Optus for years, they continue to hold my data for all this time. So it's trying to deal around those issues. I think there'll almost certainly be some exemptions for doctors who need to continue to hold on to patient records, perhaps not for continued care, but just to manage their own civil and professional risk claims. There's also a real changes towards the rights to opt in and opt out of how their private information is going to be held. So how that ties into target information in your patient registration forms, will be critical there. Artificial intelligence, we're seeing big movements in this space. So we see more and more people opting into the use of AI scribes within their business. There is a very limited example of TGA approved AI health applications. We'll see that space start to increase, I think, in the coming years. But tying into the privacy obligations, it's now an active requirement for people to be clear and transparent about how they are using AI within their business. So if you're using chatbots or LLMs, so the large language models or scribes, part of your privacy policy needs to kind of dictate and explain how you're doing that. If it's a decision-making tool, there's a mandatory requirement to say that part of our process is this mandatory decision making in respect to your private data. Non-compete. The federal government recently announced, that they were introducing a prohibition on non-compete clauses. This is obviously subject to whichever party gets into power, but for the sake of it, employees that are earning under 175 grand from 2027, those existing agreements will be void, and there'll be a prohibition of including them in agreements. It'd be nice to see what the detail is of what that's going to look like, but I would imagine that it probably won't apply to tenant doctors or doctors who work in private practice or who contract into practices. That relationship, given it's not an employment relationship, won't probably be covered by those prohibitions, but we'll wait to see. My health records are having big changes, so there's now requirements for mandatory lodgements. That's a slow rollout, but what that'll require is after the healthcare service is provided, there's an obligation to lodge those records with the My Health Record platform. That process is tied to Medicare, so if you fail to comply with those obligations, you can see an obligation to pay back some of the Medicare benefits that you've received part of that. At the moment, or just coming, the first off the rank for that is going to be pathology and radiology, and that'll just increase over time to more and more industries being required to kind of mandatory lodge those onto the platform. And obviously bulk billing is going to be big changes there, depending on who gets elected, about how the bulk billing reforms are going to come in, including the Victorian bulk billing and payroll taxes that we've seen in Victoria recently on that. Next slide. So in the end of financial year, I think it's a good opportunity to look at the existing practice arrangements, and you want to kind of be maintaining efficiency and closing out any exposures or risks that you have in your business. So that might mean sitting down with your accountant and planning for the next financial year about kind of changes ahead and getting advice on how to implement that and how to put that ahead. But also, you want to be undertaking semi-regular health checks of your business to try and ensure that your practice arrangements are above board, they follow best practice, and they're compliant. So I've got a checklist here of things to be mindful of. So the privacy regulations, I've kind of gone through a few of these. So make sure that your privacy policy is up to date with the reforms. And if you've got AI use in your practice, kind of thinking about what those risks are and how to mitigate against some of those risks. For cybersecurity, I always hear that all the cybersecurity kind of conferences that I'm going to and learning about, health sector is the highest risk industry in Australia for cybersecurity risks. It's got the most breaches in Australia. So when we think about these reforms that are going through for the cybersecurity and the privacy and how to safeguard people's data, the obligation is forever being pushed on to practice owners to make sure that those safeguards and processes are in place to safekeep that data. So that involves kind of a multi-factor approach of staff training, making sure everyone's across all of those requirements, but also dealing with the managed IT provider to make sure that you've kind of got best practice for your cybersecurity risks. For AI, making sure people are comfortable with their existing provider. If they've got an AI scribe, you're comfortable with the risk that provider has, and each AI provider has a different risk profile. They might share data differently. They might train their model on different data. So just making sure that you've looked through what their policy is on those topics and make sure you're comfortable with how that provider is doing what it does. You've got to consider whether you've dealt with all the consent processes and you've got a practice in place that says how you're going to take patients' consent for using scribes and making sure that everyone's comfortable with the use of AI within your practice, whether that's part of a practice-wide policy or a process for each individual doctors about how they're going to comply with their legal obligations. Employment agreements, they're obviously forever changing where those are, just making sure that you have regular check-ins of what the wages are, your awards, and you've got best practice for your employment agreements. Again, doctors' agreements also forever changing, the way the goalpost is on payroll tax for these. So again, making sure you've got best practice in your agreements. You've kind of managed those contracts and mitigating against common risks for those agreements. For co-ownership agreements, this is a big one for me. If you've got multiple owners of a practice, do you have agreements in place that'll help you alleviate any pains in the future? So, things like decision making, how you're going to bring in new people to the practice, how you resolve disputes, if someone wants to sell or retire, how do we deal with that? You can put an agreement in place that'll help you kind of have a pathway forward about how you're going to deal with those issues. For succession, we ask those questions. Do you have personal wills? Do you have your estate documents? It's a good time to have a think about if those aren't in place, or have they been reviewed, or up to date, or are they current? And they're going to kind of be fit for purpose for your current situation. And also with your business succession, so tying into your co-ownership agreements, do you have that kind of exit strategy, or if there's an event that occurs to you, do you know how your interest in the practice will be kind of passed on to the next person within the practice or to your family members? Or if you've got existing trusts in place, who are the appointers? How will that be taken over, and how that ties into your personal succession? Your policies and procedures, so tying into the above about your risks for privacy, cybersecurity, AI, and employment, work health and safety risks, making sure that you have and you're constantly updating your policies and procedures. And then your exit goals and strategies, making sure that, if you've got a plan on the horizon, do you need to start thinking about getting your practice sale ready? So tidying up contracts, making sure you've got enough tenure in your leasing arrangements, and tidying up your accounts. So we at Avant Law, we regularly help practices in Australia with all of these issues. So, similar to William Buck and Avant Finance, we're offering complimentary chat talks to anyone on the webinar to give you that opportunity for a health check of your business to make sure your arrangements are running smoothly. Thanks, Junior.
Thanks, Josh. Some great insights there. Bringing us home tonight, we have Daniel Pike from our Avant Finance commercial team, who'll talk to you about how we can fund your end of financial year plans and the finance offerings available to you. So take it away, Daniel.
Thanks, Junior. Hello, everyone, and thank you for taking the time this evening. As Junior mentioned, I'm Daniel Pike, part of the commercial team here at Avant Finance. Avant Finance is a relatively new division of the broader Avant Group, essentially where we exist to help doctors get into private practice, to grow their practice, or we also offer personal finance, so residential loans, investment, and owner-occupied. So it's a full suite of lending for doctors. I think some of the standouts for why coming to Avant Finance, obviously working exclusively with doctors, we understand the complex pay structures and unique sort of income streams, and we can best present those to a lender. Part of getting an approval in place, especially in commercial, comes back to the story and the why and explaining that to credit. And we've obviously got a wealth of experience doing that for doctors. We've got access to 30 lenders, so we do offer a broker service with over 400 products, but probably most importantly, we have the Avant suite of in-house lending. So we're actually lending Avant money out to doctors to help them start their practices, grow their practices, as well as buying equipment as well. Next slide, thank you. So just having a quick look at the current trends in the finance market. Anyone that's watched the news has probably seen there's a bit of economic uncertainty that's happened over the last few days. But looking at it from a rate perspective, obviously RBA's passed on their first rate reduction since November of 2020. The expectation as of the last sort of 24, 48 hours, if you look at most economists, there are future rate reductions to come, some speculating as early as May. And also speculation, we could probably see up to 5 rate reductions before the end of the calendar year. So what that means from a finance perspective is it's a really great time to start reviewing and thinking about your existing lending and how where your current loans are in the market and how future rate reductions are actually going to affect your loans. Most banks, not all, have passed on the most recent rate reduction. That's not to say that all banks will continue to pass on those rate reductions. And that's where we really start to see a bit of price competition opening up between the various lenders. And it's really important to stay on top of your current interest rate versus what other banks are offering, especially as these rate reductions start to come through. It's got a point there around variable loans. So most doctors at the moment are tending toward a variable rate loan. The reason for that is obviously rates are coming down and the expectation that they'll continue to come down. Really, the only reason you'd be fixing in this market is if you need that certainty of exactly what your repayment will be for a fixed period of time. Otherwise, we're sort of at the top of the rate cycle. Fixing now doesn't make an awful lot of sense. And just lastly, with obviously raising or increasing cost of living, economic pressures, all the rest of it, lending appetite for doctors still remains strong. I think the common sort of consensus is medical and medical allied fairly tolerant to changes in economic changes. So as a result, the banks see them as favorable borrowers, and really there's been no change to their appetite up until now. And I don't really anticipate any major changes toward that appetite either. So it's still a great time to be a doctor and looking at investment opportunities or growing your practice. Next slide, thank you. So looking at finishing up FY25 strong. So it's a great time to be thinking about your practice needs and things that you may require coming into the next financial year. So what we see a lot of at the end of financial year is medical equipment companies, car dealerships, they're all trying to run out their FY25 stock to make way for FY26 stock. So what that means for you is potentially it's a good time to access discounts on medical equipment, cars, as there's been an increase in supply of motor vehicles. So the shortage is kind of behind us now. So it is time to start negotiating. If you're looking at buying, it's probably a good time. As Paul mentioned earlier, there are incentives in place in terms of instant asset write-off. So it's another great reason to actually, if you are thinking about something you might need, doing it on this side of the financial year may make sense for you from a deductibility point of view. It's not too late if you've already bought something this year with your own cash. and you've now decided perhaps you should have taken out a loan. So if you still have the invoice for that particular piece of equipment or motor vehicle, we can organize a loan to actually do a reimbursement for that. Definitely check with your accountant to ensure that would still be deductible for your particular circumstances. But in most cases, we can actually facilitate a reimbursement for something that's already been purchased. And just coming up to end of financial year, 30 June, most banks, including ourselves, are going to be extremely busy. It's usually the busiest month of the year. So just being conscious, if you are looking to purchase things, don't leave it to the last few days of the financial year. The last thing you want to do is miss out on those potential incentives. In saying that, I would say, as you can see from the bullet point there, we've turned around business use vehicle and equipment loans in less than 24 hours, and we do that regularly. However, we obviously prefer more time if it is possible. So just planning ahead and really thinking about what you may need before, well, ideally before June, just to give enough time to appropriately plan. Next slide, thank you. So what are we talking about when we're looking at lending for equipment, business use cars, and fit out? So as I said, Avant has a full range of specialist lending for doctors. So for equipment loans, up to 100% of that particular invoice or piece of equipment with a 7-year loan term as a maximum term, and there's principal and interest repayments. And as I said before, most doctors are going with a variable rate. Car loans, again, up to 100% with a 7-year maximum term, principal and interest again. And look, when we're talking about equipment and business use car loans, typically speaking, if it's anything up to about 250,000, we can approve those loans extremely quickly with fairly limited or minimal information or input from yourselves. Obviously, we know how valuable your time is, so we try and make this process as easy as possible, and we're not asking for your full sort of financial history and all your financials. It's a quick and efficient process to get those loans. And the last bit there on the side is just about fit out loans. So if you are looking at renovating your existing practice, or potentially you've bought a new property and you need to fit it out, so we do 100% lending on the fit out while the fit out is taking place. So up to 12 months, there's actually no repayments. The interest capitalizes on the facility. And once you actually finish the fit out, the practice is open, you've started seeing patients and receiving revenue. At that point, we can actually convert that over to a business loan with a maximum term of 10 years. So the great thing about that loan is while the fit out is taking place and you're not actually earning any revenue from the practice, it's not impacting your cash flow. Next slide, thank you. So thinking about FY26, so we've got buying, starting, and expanding a practice. So obviously, all of those things take planning, and I think starting early, thinking about what you'd actually like to do, where your practice is heading, and how to achieve those goals. I think planning early is the main part. We have run a previous webinar, which is on the website, about actually starting a practice and growing a practice in more detail. But the key takeaway is doing research, understanding your market, your specialty, and exactly where you're looking to place that practice, understanding the demographic of the area, the actual specific location. Most doctors don't just pull up the online search for a property and decide to put a practice there. You do a fair bit of due diligence behind the scenes on the actual suburb and the need for that practice, as well as like your referral partners and other doctors in the area. You need to have a fairly decent understanding of what's going on in that particular area. We know and we understand that there's a fair bit that goes into starting a practice, and we don't expect you to do it by yourself. So get a team around you, speak to your accountant. Obviously, we've had William Buck this evening, who have a wealth of knowledge in the medical space. We've got Avant Law to support you from that perspective as well. Avant itself has other service offerings around feasibility studies and understanding actual suburb demographics. So speak to people, get as much advice as you can. It's going to make the process a lot easier. And having a firm business plan. I think the last thing you want to do is buy a property, fit it out, open the doors on day one, and not actually have a plan of how to run the business. Most successful practices are built around strong foundation and actually having a plan in place before the practice starts off. And now being the sort of the tail end of FY25 gives you a great opportunity to actually start planning ahead for FY26. If you do have ideas, even if it's just a thought bubble, reach out to people like myself and my colleagues today, get advice and just start thinking about it. But if we jump onto the next slide, in terms of actually financing a new practice, what that looks like. So the first one is the practice goodwill loan. So basically that's when you're buying an existing practice from a retiring doctor, or you're actually buying interest in a group practice as a percentage. Basically what that means is, we can actually fund up to 100% of that purchase amount on a 15-year loan. Principal and interest, there are interest-only options available should you wish or need them. And when it comes to goodwill, again, we've done a previous webinar. Basically, the value of that practice is based on a multiple of EBITDA. So we're looking at the practice financials of the practice that you're buying into, ascertaining fair market value, making sure that you're actually paying what is a fair price for that practice. And we'll give you some guidance around that, as well as your accountant can also help you there. Commercial property loans, so owner occupied for the purpose of running a practice. We can do loans both inside of super and outside of super. So 100% LVR applies to anything outside of super, up to 100%. Anything inside of super would be up to 80%. With the loan term itself, so 30 years applies to loans outside of super. Inside of super would be 25 years. And to be honest, 30 years loan term for a commercial mortgage is fairly market leading, in the sense that most commercial lenders typically are lending sort of around that 15, 20-year mark on a commercial mortgage. So 30 years is a great term. It's in line with a residential loan. Again, principal and interest, there are interest-only options available too. And just lastly, spoke about it already, but chances are if you're buying a commercial property, you're most likely going to need a fit out with that as well. Same as what I mentioned before, up to 100%, 12 months with no repayments. So that brings me to the next slide. So what we've put in place for end of financial year is an exclusive offer for Avant members, where we're essentially waiving the establishment fee for equipment loans, motor vehicles, working capital, practice renovations, and practice purchase. So it's a great time if you are thinking about any of those. Before the end of financial year, you're going to get the benefit of the $695 saving. And that's beg your pardon, that's for all and any existing Avant members, which I would assume most people tonight are. Next slide, please. Oh, just my details. Those are my details. If you have any questions or you'd like to speak about specific scenarios, obviously more than happy to discuss. Email, phone call, whatever's easiest. And thank you very much for taking the time out of your evening to listen to us. Thank you.
Thanks, Daniel. 100% finance on commercial property, fit out, equipment, goodwill, quick turnarounds, I heard, and flexible terms, market leading. And being able to access all of this for Avant will help prepare you for end of financial year. Now we're in the pointy end of tonight's presentation, and before we get into some Q&A, we do have I think a bit of time for one or two questions. I did want to highlight another series of Avant Growth Academy events, which Avant will be delivering in August this year in Melbourne. The Avant Growth Academy will be providing a series of in-person workshops, delivering insights specifically curated to empower doctors at each career stage. If you're interested, please scan the code on your screen for more details, and you could also save 20% for all Avant members. So that now brings us to a conclusion of the formal presentation. Now we'll get into some Q&A and particularly some questions that were submitted. Thank you to Paul as well. I can see that he's answered a number of questions in regards to the accounting side. So I might just skip over a few. And since Daniel had the floor earlier, here's a question that popped up before. Daniel, what financials slash documents do I need to provide to get a car or equipment loan?
Great question. We've tried to make it as easy as possible. So essentially, there's a single page application form, which we send via DocuSign. Takes no more than 3 minutes to fill it out, which includes a self-declared financials section. So for motor vehicles and equipment under 250,000, that would apply. And typically those are the only documents or details that we require, along with your standard sort of ID checks and all the rest of it. So yeah, to be honest, we don't need much at all. For more expensive sort of luxury cars or other motor vehicle types, we obviously would need to do a slightly more due diligence.
Mm. And just on that one more here for you, Daniel, how long does it take to get finance approved if I needed to pick up a car urgently?
To be honest, I did one last week where they called me on Thursday afternoon and they drove away with the car on Saturday. So like we can do it as quickly as required. I would say typically within 24 hours to get the approval. If it's particularly time sensitive, we can always expedite it and get things done more quickly than that. Obviously, the practice purchase, the commercial loans do take a little bit more time, and that's just the nature of the transaction. We need a bit more information. But in saying that, we can get approval within a couple of days for those larger purchases as well.
Great. Thanks, Daniel. I do have one here that I think Paul might be able to answer this. Is it better to buy commercial property under a company or under an individual from a tax benefit point of view? Paul, any?
Generally speaking, you wouldn't put a property under your own personal name, particularly commercial property, because they don't tend to be negatively geared. They tend to be positively geared. Commercial property can sometimes be good under a self-managed super fund, but you need a financial advisor to tell you that officially. The other option is you'd be looking at probably more of a discretionary trust, because you've got a good income stream, but you've also got that long-term capital growth. As an accountant, we don't tend to put assets into a company because the companies don't get that 50% general exemption for capital gains tax. So if you make a good capital gain, you can be paying up to 47% tax on that. Whereas if you structure the asset purchase under a trust, the most you'll be paying would be 23.5%. So that's a significant saving. With a commercial property, if you get a triple net lease, you can actually get all of your outgoings paid as well. So it can be quite cash flow positive. So, but again, depends on your circumstances. That's why I think everyone's offering that second consultation so we can talk about the ins and outs of your situation to give you the right advice.
Excellent. Thanks, Paul. And I think we have just enough time for one question. I might throw this one out to you, Josh. Please explain the basics and foundation of what type of company, bracket LLC versus trust, doctors can use to manage income, assets, and investments.
Yeah, so companies are legal entities that are distinct from trusts in that they're similar to people. They can own property, they can incur liabilities, they can be sued, they can sue themselves. But trusts themselves are not legal entities. It's a form of tax entity. So the trustee itself is a legal entity who acts on behalf of the trust and in the interest of the beneficiaries. And the trustee can be sued, can hold assets and liabilities. But the trust is created for the benefit of the beneficiaries of that trust. And as Paul alluded to, there's lots of different types of trusts. You can have discretionary trusts, you can have unit trusts, and there's other options you can have as well. All of them, for the purposes of managing income, assets, and investments, they have very different tax outcomes for both income tax and CGT. And that changes based on the personal circumstances of how you do, which, as again Paul alluded to, part of that second consultation to try and make sure you're getting proper tax advice about why you're setting things up and why you're doing it, because you can have very different tax outcomes.
Just to build on that, it'd be good to hear from the lawyer that a lot of people are told by their advisors, particularly accountants, that you'd set up a company to protect yourself from medical claims from the patients. Now, thoughts on that, George?
No, I don't think you can. I think that it's, it's probably more of an MI question or a medical indemnity question than it is a
I
commercial.
agree.
But certainly the relationship between a patient and a doctor is between the doctor itself, and that the claims sit in the tort of negligence and they sit under the Australian consumer law. So implementing a company there won't, whilst it does protect businesses from personal liability as part of that corporate veil, it certainly doesn't protect you from a personal services
I think
like
it's
medical
good
practice.
to have some of these myth-busting talks sometimes, because the easiest thing you could do is to tell everyone online that, yeah, you can set up a company and protect yourself, but sometimes people need to tell you the truth and you can't. And the other thing is, like we were talking about, oh, I can set a company up and I can split my income and not pay any tax and I can get away. It'd be easy for the accountant to say, yeah, do it, you're all good, and I'll charge you 5 grand to run a company. But you can't. It's cheaper to not run a company. The tax will end up with you. Get rid of the company, save your accounting fees. Unfortunately, you just got to suck up the tax. But nobody likes to tell you that.
Yeah, look, and there's some circumstances if you've got employees within that company or people under that, you do get some benefit out of that because,
You
those
have that as a
employees are
separate
shielded.
way.
Yeah, different setup, but there's obviously a use case for companies in this
Yeah.
industry.
Great. Well, I think that's bang on time and brings us to the end of tonight's webinar. I'd like to thank everyone for taking time out of your busy schedules to join us on what we hope has been an insightful evening. A recording of this webinar will be made available in the coming days, along with our contact details if you wish to reach out to us about any of the topics we discuss. Otherwise, thanks again and enjoy the rest of your night.